Wake up money time. The downturn in the economy has lowered car prices to some tempting levels. Even President Obama considering giving buyers a potential tax break. But if you decide to buy, you will most likely need to finance. And in that case, you need to know the ins and outs of car loans now more than ever. Here with that information, certified public accountant Bob Martin. Bob, good morning to you.
Good morning.
Let's go buy a car.
Yeah.
I like the sound of that.
Well, and there are a lot of incentives out there. It looks like there may be some incentives in the stimulus package if you buy a car also.
And, the ins and outs of buying a car is always seemingly a complicated deal, probably now more than ever. Where do you start?
You start by focusing on the features and the purchase price. There are a number of what they call upcharges that a dealer could charge you. And we've found that the dealer financing packages that are offered are usually the least beneficial to the consumer.
Which means the smart buyer would contact some sort of financial institution, their bank, for example, a credit union, and get some financing in hand before they go to the car dealer, right?
Exactly. And go in and tell the salesman, I want to focus on price, I want to pay cash for the car, which obviously does not mean you're bringing in a briefcase full of money, but you have your own financing. And then you can just focus on the price, and you don't have to worry about these other add-ons.
So when the salesman starts talking about, well, let's do this, let's do that, you want to say, let's just talk about the price of this vehicle and what it's worth to you and to me.
Give me your best price.
A lot of the automakers, obviously, they've been in the headlines with their problems. There is 0% financing available. So that sounds pretty enticing.
It really does. You think, why wouldn't you turn that down? But you may end up paying more for the car, or you might not be able to get a rebate because somebody has to pay for that 0% financing, and in the end, it is the consumer.
Yeah. So it is easy, and it has been in the past, for people to stretch themselves way out of proportion as far as their budgets. Same with home buying. What percentage of your disposable income should be going toward a car?
You shouldn't have more than 20% of your disposable income going toward the car, and focus on the term of the loan. You know, we've had car loans that are over 5 years, and what happens is people get what they call upside down in their car, which means the loan is higher than their car is worth, which can be a very terrible situation.
Which really gets to the length of the loan.
Right.
In the good old days, a 24-month loan, 2 years, it's nowhere near 24 months anymore, is it?
Because of the high price of cars, it's probably not possible for most people to get a 24-month loan, but try a 3-year loan if they can, a 36-month loan, and don't go out over 5 years.
All right, Bob Martin, as always, we thank you very much for the wisdom as people go out and buy a car. Let us know how it goes. Thanks, Bob.